Fisker, Lucid, or Rivian? Which one is the better EV stock to buy right now? That's the question I'm going to answer in this video. I'm going to compare these three troubled EV companies across several critical financial metrics to determine which one I think is the better one to buy for 2024 and beyond. So let's jump right in and let's look at these three EV stocks.
I want to thank the Motley Fool for sponsoring this video. Visit fool.com/Parkev for the 10 best stocks to buy now.
So the first thing I'm going to compare these three on is revenue. And starting with Rivian, you can see it's in another world of revenue. 1.33 billion in its most recent quarter, compared with 137 million for Lucid Group and 71.8 million for Fisker, which only recently started delivering vehicles. Only one quarter of performance so far available from Fisker on its revenue. Now, I wouldn't be surprised if in the next 1 or 2 quarters, Fisker surpasses Lucid in terms of quarterly revenue. Lucid, selling luxury automobiles, hasn't quite found a niche for itself. Meanwhile, Fisker, lower priced, more affordable cars, SUVs that are more popular with consumers, and Fisker doing the outsourcing business model, which makes it easier to ramp up production, ramp up sales more quickly, although with lower upside. So Rivian, also, I suspect its revenue will grow in 2024 and it will maintain or even increase its lead over these other two EV companies. So the next thing I wanted to look at is operating profitability or the lack thereof. What I have here is the operating income for these three companies, and they're all losing money, a lot of it on the bottom line. 103 million in operating loss for Fisker in its latest quarter, 752 million in loss for Lucid in its latest quarter, and 1.44 billion in loss for Rivian in its latest quarter. I suspect these losses will continue for all three of these companies. Fisker, I think, has the best chance of achieving profitability the quickest because of its outsourcing business model. Rivian is expected to deliver gross profitability on the fourth quarter of 2024. Still, I think Fisker's profitability prospects are better than Rivian, although longer term, Rivian has better prospects than Fisker. Shorter term, the outsourcing business model achieves profitability quicker. Longer term, the outsourcing business model has lower peak profitability because you're outsourcing, you're not achieving the same economies in scale. You hit a peak and you can't go beyond that because you've outsourced your production. Now, that doesn't mean they can't change that at some point and say, okay, we're going to bring production back in-house. NIO is one EV company that's doing that right now as we speak. So we'll get some data from NIO whether or not that's a smart strategy to go from outsourcing to bringing in-house. Still, these companies losing a lot of money, they will continue to lose a lot of money on the bottom line. The next thing I wanted to highlight is cash flow from operations. Cash flow from operations is one of the most vital metrics I consider when making an investment decision. If any financial shenanigans are happening, looking at this metric can help uncover the fraud. Moreover, looking at profitability without considering cash flow from operations can lead to a misleading picture of a company's performance. For instance, look at the example I have created here. The company reported a net loss of $250. However, when you look at the cash flow from operations, it was a gain of $35. How can that be? Well, two expenses a company must report on the income statement are depreciation and stock-based compensation. Importantly, these are non-cash expenses. Money is not leaving the company for these expenses. In the case of depreciation, when a company buys a machine for $750, it pays all of that price up front. However, generally accepted accounting principles require that the company take the expense over a period the machine is expected to operate. So if the machine is expected to last for 10 years, The annual expense will be $75 per year for 10 years, even though the company paid the $750 cash at the time of the purchase. Also, when a company offers its employees a stock option, it's not parting with cash. However, it must record the cash value of the option as an expense on the income statement. So moving on to the working capital items, inventory management is the easiest way a company can increase cash flow. The simplest case is when a business has 100 inventory units, sells 30 units, and doesn't replace those units. The decision would reduce total inventory and increase cash flow. As you might already be thinking, this isn't sustainable. Eventually, the company will deplete all its inventory and go out of business. Accounts payable is the money that a company owes another company and has not paid yet. And accounts receivable is the opposite. A company can increase its cash flow by collecting payments faster and paying suppliers slower. If done with skill, companies at scale can take advantage of these timing differences to boost cash flow by a couple of percent annually. Costco is one example that employs this strategy masterfully. Overall, if you observe cash flow increasing unsustainably, you should expect a reversal of that trend. The other big risk to consider is if you see a company reporting substantial profits but negative or weak cash flow due to rising accounts receivable. And so now that you have an idea of how important cash flow from operations is and how it works, let's look at the numbers. Fisker, negative 305 million, headed in the wrong direction. Lucid, negative 513 million in its latest quarter. It looks like it's made the reversal and is making improvement, achieving or progress towards becoming self-sustaining in cash flow. And Rivian making significant progress, but still negative 877 million. You can see though from negative 1.5 billion, it's made progress forward. And I wouldn't be surprised if it continues making forward progress, especially if it does achieve gross profit margin in the fourth quarter of 2024. That will help significantly in making progress in cash flow from operations. And so since these companies are losing so much money, I want to see how much cash and short-term investments they have on hand. Rivian is in an excellent position. It's got $9.1 billion in cash, although you can see just how much cash it has burned through to get to this point. It used to have $18 billion of cash. It now only has 9. So it's already burned through $9 billion at least in getting itself to where it is today. Lucid Group has $4.4 billion, a solid balance to be sure. And the lowest is Fisker at $529 million in cash and short-term investments. Fisker recently made a deal with a strategic investor that should free up some of its restricted cash, and it converted some of its long-term debt that's coming due next year to shares, issuing equity instead of having long-term debt, which gives Fisker more of a runway, more of a cushion before it needs to raise more capital, although I think it will soon need to raise more capital in the near term. And finally, valuation, and I'm using the forward price to sales ratio, and according to this metric, Lucid is the most expensive at a forward price to sales of 1.681. Then you have Rivian at a forward price to sales of 1.429. And finally, you have Fisker at a forward price to sales of 0.081. Fisker is incredibly, relatively cheap compared to these other two EV companies. Relatively speaking, Fisker is much cheaper than these other two EV companies. And if you asked me, I would not want to own any of these three EV companies right now. They are just in too much trouble. They're losing too much money, and supply for EVs is growing much faster than demand. And so you have this imbalance between supply and demand. Demand is there, right? It's growing. But the problem is that supply is growing so much faster than demand. That's creating a lot of trouble for a lot of these newer EV companies. So if I had to pick though one of these three, I would pick Fisker just because it's so much cheaper than the other three. I would pick Fisker right now as the better EV stock. Did you know that over 90% of the people that watch my channel are not subscribed? It'll really help support my channel if you hit that subscribe button. And oh, by the way, one of the benefits of being subscribed is that I take requests from subscribers more often than I do from non-subscribers. So if you prefer that benefit, please subscribe to the channel.